Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of January 25th, 2026. And in this week's episode, we are going to touch on the third installment in the Investor Miniseries, putting our money to work. And what we're going to look at is different options for putting that capital to work for us to grow our wealth, and what a portfolio composition is going to look like, what different variables in that portfolio composition would be, and really kind of dive into that, building upon the first two episodes. But before we hop to that, I want to give a shout out to our Discord, a link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading, love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. And in this week, we are going to take a look at the third installment of the Investor Miniseries. And to recap, this is going to build upon the first two episodes. So I will put a link up above to episode number 2. And watching that, there'll be a link to episode number 1 from there. So if you feel like we're missing something or forgot something, or I make a reference and you don't understand it, go back and watch some of those videos. If you look at the upcoming content and you're like, you know what, I'm putting my money to work, I'm already doing that, I want to hop to something else, feel free to skip ahead to one of the episodes 4 or 5. But in this episode, we're going to build upon the knowledge that we already touched on in episode 1. So episode 1, we talked about, hey, what are the different types of investment accounts out there, brokerage accounts, IRAs, 401ks, what might be right for you? We talked in there about establishing a savings goal, a purpose for this money, because that gives you a sense of where you need to put the money from a access standpoint. Do you need it in a year? Do you need it in 10 years? Do you need it in 15 years? In episode number 2, we really started looking at risk tolerance and how do you start gauging your risk tolerance and what are the different asset classes that you can put money into that correspond to different risk tolerances. Now, this week's episode, we're really going to talk about then combining those two things to understand what is a portfolio composition, what might that look like from a example perspective, and what you might do to find the funds to establish that portfolio and build on those positions. So let's jump right into episode number 3, putting your money to work. And the first thing we're going to really start talking about is portfolio composition. And you might think, well, what the heck is a portfolio? And if we take a minute here to just kind of talk about the elements of what a portfolio is, at a very high level, a portfolio is simply the collection of the various holdings in aggregate. So it's the entire basket of what you hold from an investment standpoint, from where are you putting your money, what's there. That collection of all of those things is referred to as your portfolio. Now, the total composition of that really determines your risk. So you could have really, really risky things in there, but if you don't have so many of them and you have lots and lots and lots of low risk things, the aggregate of your overall portfolio would be relatively low risk. And so we talked about risk in previous episodes, and really what you want to target here is what's your risk tolerance, and that's going to guide the portfolio composition of how much of risky assets do you put in there, what percentage of it. Do you put any? Do you put in a lot? That's really going to guide some of that. And the big thing that I would say is the takeaway here is focus on percentages, not absolute numbers. So don't ever say, oh, I want, $10,000 in this, because that doesn't scale, right? $10,000 in a particular holding might be 100% of somebody's portfolio, but it might be 1% of somebody else's. And so if you really think of all of these allocations in terms of percentages, it really normalizes it to no matter what the base amount is, you basically are distributing it at a percentage basis across there. So really ditch any sort of absolute numbers when it comes to portfolio composition and really focus on those percentages. And last, keep in mind the classification that we talked at before. If we really are going to go with big rocks first, and then we break those down where we want to kind of drill in or get a little bit more specific. So in general, Your portfolio will have one of three elements, two of three elements, but basically everything will be three element types. And whether or not, based on your risk tolerance, you may or may not have this type. And then you might have a lot of it, you might have a little bit of it. And that's cryptocurrency, which is by far the riskiest asset class type that we have talked about in episode number 2. Stocks would be your middle ground, and there's a huge array of risk within each of these categories. So yeah, there is absolutely lower risk cryptocurrency. There's absolutely high risk cryptocurrency, but in general, cryptocurrency is going to be your highest risk asset. Stocks, yeah, there is safe stocks or low risk stocks, and there are very, very high risk stocks, and the whole gamut is going to be in there. And then you got bonds. Bonds are going to be traditionally lower risk than stocks and cryptocurrency, but they themselves will have a different stratification among the different classifications there. So really keep this in mind that we're going to start off with how much of a percentage in each of these areas are going to go into our portfolio composition. So here's a little bit of a visualization on this portfolio composition. So I got the red color would be your risk level, right? High risk cryptocurrency. Yellow color are going to be your stocks. Green color are going to be your bonds. And what I've got here is 3 portfolio compositions from lowest risk to a higher risk, not absolute highest risk. You can extrapolate this out and really kind of draw any different percentage. But think of things like this. So think of your total portfolio. And for some people, if you want the absolute lowest risk, you kind of want to set it, forget it. You don't want to worry too much about it, right? You might have a 100% bond portfolio. Now, your returns, as we talked about in episode number 2, are going to be inversely proportional to the risk, or I should say the potential return rate will be inversely proportional to the risk. So that first one, we got 0% cryptocurrency, 0% stocks, and 100% bonds. Moving down one to that middle bar chart, this is going to be kind of your typical, you've probably heard a 60-40 portfolio, 60% stocks, 40% bonds, no cryptocurrency. That's why we got yellow and green, and that's just something out there that you could have. Now, if you wanted to start sprinkling a little bit more risk, maybe you got 15% in cryptocurrency, 75% in stocks, and just 10% left in bonds. So notice all of those things add up to 100%, and you can basically take any dollar amount and distribute it amongst that proportionally, as long as you're working in percentages, which, as I said, stick with percentages. It's going to be easier in the long run. Now, there's really not a lot to kind of go off of here on this screen, because you're like, well, how much risk is the first one? How much risk is the next one? How much risk is the third one, right? What do I take? And this is really where a lot of that experimentation and where your comfort level is going to have to go to explore. But let's try to start with a little bit of rules of thumb, or what's some of the frames of reference when you want to think about risk, and how much should you have on there, because it really depends on how far away are you from you needing to access that money. So if I look at this from the standpoint of a retirement portfolio and age-based things, so I'm going to temporarily say, or not temporarily, I really want to focus on just a portfolio for the average person. So the average person, my recommendation really is to focus on stocks and bonds. Leave cryptocurrency out of it. If you want to ramp up later with risk, or you want to ramp up later in your portfolio composition, sure, add it in later. But you know what? Just start off with your stocks and bonds. This is going to be your bread and butter when it comes to preparing for things like retirement. A general rule of thumb, or traditional rule of thumb, has always been whatever your age is, put that in your bond percentage. So if you're 20 years old, you should have 20% in bonds. If you're 65 years old, you should have 65% of your portfolio in bonds. Now, because we're only dealing with stocks and bonds, the inverse of that, or 100 minus that number, would be the percentage of stocks. So if you're 40 years old, you'd have 40% in bonds and 60% in stocks. Now, that is pretty conservative, at least in my opinion, because that really kind of gives pretty heavy weighting to bonds. So a more modern rule of thumb would be 120 minus your age is your percentage of stocks. So if, for example, you're 35 years old, you would take 120 minus 35. that would give you 85. So you should have 85% in stocks and 15% in bonds. Now, I personally tend to like this metric a little bit better. It resonates a little bit more with me, but you can research this to figure out, hey, where do you think you fit from a percentage of allocation? But just start with that percentage at that very, very top level, and we're just going to drill down from there. So for the rest of this talk, I'm going to focus on a 35-year-old using that modern rule of thumb of 120 minus your age. So everything from here on down is going to talk about 0% cryptocurrency, 85% stock, and 15% bonds. Now, before I get into a little bit deeper dive of kind of stepping up the advancement of the portfolio, I really want to remind us all about what we talked about in episode number 2 when it comes to asset classes, risk, and the different elements of that. And so starting at the top, the highest risk, this is going to be your crypto. We have your niche coins, moving down into your more mainstream tokens, and then moving down into the riskiest part of stocks, which are going to be your individual names, your futures, your options, your derivatives, that type of thing. Then we're going to move into theme ETFs like solar ETFs, AI ETFs, ETFs that are really focused on a particular theme. Those are going to be your next click down from individual stocks when it comes to risk. So we're getting lower and lower risk. From there, you're going to get into your sector ETFs, large cap market capitalization would be a sector ETF, or a particular complete automotive sector, or consumer discretionary, financial. All those ETFs would be kind of one click down then from the theme. Then you're going to get into your index ETFs. Your index ETFs might be the SPY, the NASDAQ, which would be the QQQ, things that are basically tracking entire market indexes. Then when you move into bonds, and in bonds, you got junk bonds as the riskiest bonds. Then you got investment grade bonds. And this is all going with the rating of the lending that's going on, getting less and less risky. Municipal bonds, those are your government bonds of cities, states, localities, things like that. Then federal bonds are going to be your federal government bonds as the least riskiest things. Kind of the zero or the risk-free rate is always the U.S. Treasury is largely considered the risk-free rate when it comes to investments. So where does all of that land? Let's start with the very most basic portfolio. And this is where I would say is the base case portfolio. Now we're going to build in portfolio complexity from here. We're going to touch on a few different types, and I'm going to talk through what is the difference in these portfolios. What are you adding to it? And then I'm going to jump into some screeners on how you look to fill this stuff. So we're starting to draw the picture. We've got an idea of what we want that picture to look like because we've talked about our risk tolerance. We've talked about the composition, and we're really zeroing in on that 0% cryptocurrency, 85% stocks, 15% bonds. So base case portfolio, 2 funds. That's it. 1 fund for stock, 1 fund for bonds, nothing else. 2 fund portfolio. So what you're going to want to try to do when you're building a 2-fund portfolio is you want each fund to be as absolutely wide as possible when it comes to that particular category. So if you want to hold 1 stock fund, you want that stock fund to be as representative of the entirety of all stock options out there. If you want to hold the bond fund, you want that bond fund to encompass junk bonds, investment bonds, federal bonds, municipal bonds, all of that stuff. We want it to be as wide as possible to cover the whole category. This is going to be the absolute kind of base minimum starting point of things. Now, this is also relatively easy to build because all you got to do is find 2 things and pick 2 things. 1 stock fund, 1 bond fund, put your money into it, 85% to the stock, 15% to the bond, and just keep cranking away at it. Now, you might find that a little bit boring. Maybe you want to add something. The next step up in complexity is what I would call the standard portfolio. So this is going to be more than that fund. So in total, your whole portfolio is probably going to have 3 to 4 funds. And you can decide whether or not you want 3 stock funds and 1 bond fund. But this is not going to be many. It's going to be less than 5 total funds. And again, you're going to want the funds to be pretty wide, but because we're putting more than 1 fund in each of these categories, potentially, we want that whatever we end up putting in, think of a Venn diagram. So that's where you got these 2 circles, and you want to keep that overlap as small as possible. And there's different things out there when you look at the composition of these, what is in the fund that will help you understand how much overlap is there between the funds that you have chosen to look at. So one suggestion I have when it comes to the stocks is we talked about in the base case portfolio to really keep that as absolutely wide as possible. So you want it to be in stocks, the entire stock market world. Now, if you want to break that apart into two independent funds, you know what you might want to focus? You might want to introduce the split between domestic and international. So maybe you want to pick a domestic stock fund to be part of that 85% and an international to be another part of that 85%. Now, how much of that 85 do you want to allocate to domestic and allocate to international? That's what you get to decide. Now, fundamentally, it's still stock, so you're still going to make that up to 85%, but maybe of that 85%, you want to go 50-50. Or maybe you say, you know what, the U.S. is really heated up right now. There's more growth potential in international funds, so you want to maybe weight yourself a little bit heavier in international ETFs versus domestic ETFs. This is starting a little bit of that recipe that you get to sprinkle in. When it comes to bonds, maybe you might want to consider things between federal and municipal split. So again, we're kind of building up on complexity, building up on risk. So the base case would be your lowest risk, lowest complexity. We're starting to introduce it. So it would make sense that we want to focus there on the bottom part of that previous categorization of assets to say, you know what, let's leave junk bonds out. Let's leave investment grade bonds out. Let's just focus on municipal and federal bonds. And maybe you have two bond funds. Maybe one is a federal fund and one is a municipal fund. So let's keep building from there and say, let's add a little bit more complexity. Let's add a little bit more risk to our split of funds. And we're going to get into what I call the prosumer portfolio. So now we're basically doubling the number of funds in the overall portfolio basket. So now we're going to go after 5 to 8. Again, you really want to be cognizant of the overlap between the funds. Because if you have two funds that completely overlap with each other, well, why the heck do you have two funds? You're covering the same area. So you really want to watch the overlap in the funds. And particularly in trading funds, there could be a lot of overlap because they're big baskets of holdings of things. Now, with stocks, maybe here you want to introduce a little bit of sectors. So we talked about a domestic and international split. Maybe here you want to focus on, here's a fund for small cap growth. Here's a fund for mid cap value, maybe a large cap growth, right? All of these are different categories or sections or sectors that you might want to add into that. Maybe here in the bond section, maybe you want to add a little bit of those investment grade corporate bonds. And we're just building up a little bit more. And this is completely like a recipe that you get to tweak yourself. You get to sprinkle in what do you want to try? What do you want to put in there? But fundamentally, your overall portfolio is going to be anchored in that base risk of 85% stocks, 15% bonds. Now, as we ramp up from that prosumer portfolio, we're going to get into what I call the professional portfolio. So now we're adding a little bit more. And this doesn't mean professional like, oh my gosh, you can't have this unless you do this for a living. This is just kind of getting a little bit more advanced, picking a little bit more from the buffet line, if you would. So again, focus on that overlap because it's really not good, in my opinion, to have overlap between funds. Look at the composition of them, make sure that they cover different areas of whatever space that those things are in. So here you might want to start introducing themes. Maybe you want solar ETF funds. Maybe you want an AI fund in there or anything built around an investment theme. Maybe this is an appropriate place to add that in. Maybe in the bond area, this is where you're going to introduce junk bonds. You know, you've got your corporate bonds already in there. You've got your municipal bonds. You've got your federal bonds. Maybe you want to sprinkle in a couple of junk bond type holdings. So for the professional portfolio, that's going to take us to the very last portfolio that I want to talk about. And this would be a complete custom portfolio. So when I say complete custom, I mean, maybe we don't have any ETF funds in here. We are 100% going to start picking individual stocks. Maybe we're going to start picking individual bonds. Maybe we're going to buy Apple, Microsoft. We're going to pick some new startup company and put money in the IPO, right? This is where you're really picking and choosing. And so I don't have a particular number here. It's just many, 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 many things. And you can mix and match all of this. So don't think of this as just what I've laid out here. For example, one of the things I like to do is say, you know what, in that meta breakdown of 85% stocks, 15% bonds, in that stock section, maybe I'll carve out 15% of that 85%. I will allocate to individual names to say, you know what, I want to take a moonshot at something. I really think this is an up and coming technology, and I will put individual investment in that world. So this just kind of shows you a little bit of an example on how you can take that base risk classification stuff, allocate different percentages out of that to each one, and then you can slowly drill down as you're comfortable on that spectrum of picking and choosing more or less funds. You can keep it as absolutely drop dead simple as that base case: one bond fund, one stock fund. Maybe you start there and then you say, you know what, I want to take my 85% and let me start dabbling in some index ETFs, but I'm a little uncomfortable with that. So let me go ahead and start off with maybe just 5% of 85%. Anything you can do, you can really break it apart and kind of drill into it from there. All right, now the very last part of this video that I want to touch on is, okay, that's great. You've got all this idea of the different fund categories and stuff like that, but Sprocket, where the heck do I figure out what funds to pick? How do I know what to put in that portfolio? Where am I going to figure that stuff out? And that's what I want to touch on here. And I'm going to use the example of Charles Schwab because that happens to be my broker. This goes back to that episode 1 where we talked about the differences in the brokerages firms, what you want to get at, and the fact that full service brokers, in my opinion, really kind of cover everything that you need. And I really think everybody should really zero in. If you're unsure where you want to go, unsure what to do, look at Fidelity, look at Schwab. Those are the two biggest players. They have pretty much everything that you can need in there. And so I use Charles Schwab in my retirement account, and that's what I want to pull up, and I want to talk you through some of the stuff on the Charles Schwab platform. So as I move over to the Schwab thing, I've kind of logged in and I've gone into the research area of Charles Schwab. So as I pull up this ETF screener, you'll notice here over here on the left, you got your basic criteria. And everything is going to be a little bit different, but if I really drill into this, we can look up portfolio. And we were talking about that base case and how do we start picking something that might cover an entire market of stock funds or an entire market of bond funds. So we can come in there and we can say total holdings. Maybe that's a parameter that we want to look up. Now, in this case, the total holdings can say, do you have more than or less than 250 total holdings? But we actually want something that has a lot of holdings, right? Because we want this to be representative of the entire market of things. So maybe we say, what has more than 1,000 holdings? Well, there's 294 funds that have more than 1,000 holdings. And if you scroll down, we can say we can view these matches and it'll start showing, but maybe that's too many. That's still a lot of funds to look at, a lot of things to weed through. So if we come back over here, maybe we want to look at ratings. I really talked about Morningstar ratings. Morningstar ratings are really, really good ratings to look at. So maybe we want to say, you know what, only show me 5-star overall mornings rating funds that have over 1,000 holdings. Well, now we got the list down to 12. So this is 12 funds that basically are 5-star morning fund ratings that have over 1,000 things. So what are some of the names of this here? We got State Street Spider S&P 1500 Value Tilt ETF. Well, this has 1,463 total holdings. So this might be something we want to look at. We can kind of look at just the name of them will kind of tell you what is the comprised inside there. Now, if we go back to that over 1,000 holdings, what I want to show you here is maybe you want to sort by the number of total holdings. So we can go ahead and sort by that and say, well, what has the most? Well, right here, the most funds are this BND, which has 17,750 different holdings. Now, I wanted to do this sort because we wanted to talk about that base case a little bit. This is a particular fund that I say really encompasses the bond market. If you look at the name of this, it's called Vanguard Total Bond Market Index Fund. Right here is BND. It's got all of those things. So BND might be something that we want to look into. So if we take a look, we can then use our broker. We can look up the BND ticker. Now this is what it looks like on Schwab. And one of the things, this page will tell you everything there is to know about the BND fund. It'll tell you what's the expense ratio. Expense ratio means, hey, how much does it cost to run this fund? Means this is going to come out of the money that you get. So 0.03% fee gets paid to this. Very, very low fee. It has $384 billion. I talk about prospectus. And so this page is going to say, what are the fund documents? And if you click on the fund documents, one of the links that's going to be there is going to be the prospectus report. And if you click on the prospectus report, it's going to open up another window and it's going to show you the prospectus of that particular ETF. And that prospectus is going to tell you who runs this, how do they run it, what are the rules. And this is really where you're going to start looking through all of the things around it. One of the other things I would say in that base case portfolio, one of the funds that I have is VTI. Again, it's a Vanguard fund, but if I bring it up here, it's going to be the Vanguard Total Stock Market ETF. This has the holdings that try to track the entirety of the stock market, domestic, foreign, has many, many, many funds. It actually has 3,541 different stock holdings inside of it. Again, it has very low fees, and this is really trying to encompass all of that total stock market. So if you're going with a two-fund approach here, maybe you're looking at VTI and BND, and you just buy those two funds. And 85% of your money goes to VTI, and 15% of your money goes to the BND fund. And this screener is really where you can dig in to pick through that to figure out what it is that you want to break apart, research, stuff like that. So this just should give you an example. I really don't want to I could spend hours and hours and hours covering all of this part. If there's something you want to talk about, you want to hear about, let us know in the comments below. Otherwise, this is just the basic tools that you can use to get out there and start breaking down your portfolio. And that brings us to the end of this week's episode. The real premise of this is to really kind of talk through at a high level that composition and how it's all built on those three risk classifications that we talked about in episode 2: cryptocurrency, stocks, bonds. And then based on your risk tolerance, you're going to break up the percentage of your funds into those three categories of things. And then based on your confidence level, based on your interest, you're then going to take each of those categories and break them into either leave them in a singular fund, or you're going to break them into more varied funds that might roll up into that. And how you're going to sort through the thousands and thousands of funds out there, you're going to log into your broker. You're going to go to their research area. You're going to use their screeners. Their screeners are going to be very numerous with lots of metadata that you can start zeroing in on what you want to look at. They will have the ability to say how many holdings are there, what's the market capitalization, what is the ESG rating around it? That's the environmental, society, governance, safety governance aspect to things. And pretty much every aspect you can imagine, there's going to be a filter for that. And you're not going to sit down in an afternoon and pick what you want to invest in for the next 15 years in 5 minutes. You're going to look at it. You're going to start pulling up prospectus. You're going to start looking through that. You're going to have questions. I encourage you to go to an LLM, ChatGPT, Claude, one of those AI models, and just kind of ask questions about it. You're going to see terms, hear terms, read terms you might not know about. Read through it. Hop in the Discord. Ask us about it. This is the type of stuff where it's just so numerous and voluminous of information. Trying to cover it in detail would just be boring if this was not boring already enough. And you have to to get into it yourself and figure out what are the questions that you have. At the end of the day, you might not really need to drill into all that, because maybe you just want to say, hey, give me the top 2 5-star morning rated things, and you just want to pick from that. That screener is going to allow you that granularity to decide how deep and how far down that rabbit hole do you want to go. Now, in the future episode, we're going to start saying, okay, cool, I've picked my portfolio, I've picked this stuff. Now, how do I measure my performance? How do I know if I'm doing this the right way? How do I understand if I'm going good or bad? And so that's really going to be the future episode on how you measure performance, whether or not it's your individual performance, your financial advisor's performance, or however you choose to manage that. We're going to talk about how you measure that performance in the next episode. Hopefully you found that interesting and you found some nuggets of information. Good luck out there. Have fun. And remember, think outside the block.